Here are 3 ETFs that could make you richer than SCHD. Now, don't get me wrong, SCHD is a powerhouse among dividend growth ETFs. If you have a low risk tolerance, it's a fantastic choice because it focuses on companies with strong fundamentals and history of paying reliable dividends. This makes it a safer bet during turbulent times. Plus, SCHD is primarily invested in sectors like consumer staples and healthcare industries that tend to hold up well during market declines. It offers a diverse mix of top-notch, high dividend paying companies providing a steady stream of passive income, especially important when interest rates on bonds are low and you will still want reliable income. But let's shake things up a bit. The question that I had is, are there even better ETFs like SCHD on the market? So after a deep dive into research, I found 3 ETFs that could potentially outshine SCHD. These gems that I have found not only deliver solid dividends but also boost outstanding performance over the last year. And if you stay to the end, I will tell you if I would replace SCHD or not with one of those ETFs. So let's give these 3 ETFs the spotlight they deserve. The first ETF on our list is the FDVV, the Fidelity's High Dividend ETF. This ETF focuses on investing in a diverse range of large and mid-cap dividend-paying companies that are continue paying and growing their dividends. With a competitive expense ratio of just 0.15% and a solid current dividend yield of 2.7%, FDVV presents an attractive option for dividend-seeking investors. It has launched in 2017 and FDVV currently holds a total of 107 positions and it has demonstrated impressive performances, averaging a return of 14.8% per year over the past 5 years. The top sectors include information technology, industrials, consumer staples, and utilities, featuring high performance companies such as Apple, Nvidia, Microsoft, Procter & Gamble, Broadcom, and ExxonMobil. This ETF is particularly well suited for investors with higher risk tolerance due to its significant exposure to tech stocks. So if you want more detailed comparisons like these ETFs for the best returns to help you grow your wealth smarter and faster, be sure to subscribe to our channel for the latest insights. The second ETF we are discussing is the DGRO, the iShares Core Dividend Growth ETF. What makes DGRO special is its strong 4-star rating from Morningstar and its gold medalist status. These achievements show that DGRO has the potential to outperform other funds. A gold medalist from Morningstar means the fund is excellent thanks to great management, a solid history of performance, and low fees, which help build trust in its future returns. This ETF's goal is to invest in US companies known for consistently growing their dividends. Dividend growth stocks are valuable because they often come with lower risk. And these companies typically have lower payout ratios and stronger balance sheets, making them more resilient in challenging markets. And this is why I chose DGRO along with the other ETFs. With an expense ratio of 0.08%, DGRO is really efficient in managing costs, what is enormous important. And remember, keeping costs low is crucial because it significantly impacts your overall returns. The current dividend yield is over 2%, mainly because the stock price has gone up a lot. This means that even though the dividend payments haven't changed much, the increase in the stock's value makes the yield look smaller. It's launched in 2014 and DGRO has mainly invested in sectors such as financials, information technology, healthcare, and industrials, holding 413 companies, and this means you get excellent diversification among top performers like ExxonMobil, JP Morgan, Apple, Microsoft, Chevron, and Johnson & Johnson. DGRO has a proven history of consistently increasing its dividends, living up to its name. Over the past 5 years, it has achieved impressive annual returns of over 12.56%. And over the last 10 years, those returns are around 12.2%. So this fund is perfect for investors seeking strong dividend growth and who may accept a lower yield now, with hopes for substantial growth in the future. With its exposure to technology stocks, DGRO aims to outperform SCHD as it has consistently done over the past decade. The third ETF we are diving into is the DIVB, the iShares Core Dividend ETF. This fund really stands out with a 4-star rating from Morningstar, and it also earned a prestigious gold medalist award. And that's a clear indication that BlackRock knows how to effectively manage these dividend-focused investments. So let's take a look at some key highlights. The expense ratio of this ETF is 0.05%, which means more money stays in your pocket. The dividend yield is currently around 2.4%. Now, how does DIVB spread its investments? It covers a wide range of sectors like information technology, financials, industrials, and healthcare. In total, it holds 433 companies, and some of the big names you will find in this fund are Cisco Systems, IBM, Accenture, Texas Instruments, ExxonMobil, and JP Morgan Chase. So let's talk about performance. The 5-year return is an impressive 14.18% annually, and it is launched in 2017. So now is the big question, do I want to trade my SCHD for these 3 ETFs we've talked about? And to determine if any of these ETFs can replace the SCHD, I always start by looking for a minimum track record of 10 years. And this criterion eliminates DIVB and FDVV since both were launched in after 2014. So what do we have left? We have SCHD, which has a solid history averaging about 11.7% annually over the past decade. And in comparison, we have the DGRO, and that has also shown an impressive performance with an annual return over 12.2% per year. So what is the best option? I would typically invest in SCHD during volatile market conditions when seeking stability, especially if you are a retiree looking for a reliable income stream. SCHD is a great option due to its high dividends and focus on high quality companies with strong dividend histories, making it a solid choice in uncertain markets. On the other hand, you might consider investing in a DGRO when you are looking for more growth potential in addition to income. If the market is more stable or more bullish, DGRO's strategy of focusing on companies that consistently grow their dividends could lead to better capital appreciation over time. So it's suitable for investors who are willing to take on a bit more risk for potentially higher returns. So in this video, we are diving deep into the SCHD, a long-term favorite of mine. One key benefit to consider is that SCHD is designed for those who want to grow their wealth smarter and faster. So let me know in the comments below which ETF you prefer. See you in the next video.